With much honor and pleasure, I invite Mr. Abidali Neemuchwala, the former CEO of Wipro, to inspire us with some insights from the business world, especially through the eyes of a venture capitalist. Welcome, sir, to the Shriram Economic Summit 2021.
Thank you, Abhiram and Kanish. Can you hear me clearly?
Yes, sir. Yes. Sir,
Yes.
just before we begin, a few from our audience wish to ask you some questions. Shall we take them now?
Absolutely. Go ahead.
Yeah. So, sir, as a venture partner in DVP, you invest in early and growth stage startups, both in the US and in India. In your experience, what is the main differentiating factor between the tech startup culture in the Silicon Valley and the one in India? How can this be bridged if there is a need at all?
Absolutely. Any other questions? Good. So, good evening, everybody. First of all, I want to congratulate the Shriram Economic Summit organizers for organizing this event and thinking about venture capital as one of the topics. This is very progressive, very forward-thinking, because this is what we need in India for young people to be excited about. I also want to thank you for inviting me to share my thoughts. And I will tell you, I am a freshly minted venture capitalist. I've spent my career of 28 years in technology, but for the first time in the last 6 months, I have personally embarked with my own money into venture capital. Before that, I participated in venture capital. Essentially, when I joined TCS in 1992, although it was never called a startup, but now, if it was in today's age, it would have been called a startup. And the Tata Group was nothing but a venture capitalist to be able to invest in a company at that time where the investments were much bigger than the revenues or profits that happened many years later. Similarly, I had the fortune to work with Wipro, and similarly, Mr. Premji has been a venture capitalist giving rise to new businesses. So venture capital is not new, but now it has got a much more, I would say, structured format. So let me share a few thoughts for about 15-20 minutes, and then take more of question answer so that we can make this session interactive. I know there are about 170 participants on this call, and there may be many questions. I would like to keep most of the time for you to hear what you want to hear and do it through question and answers. Let me cover some basic concepts of venture capital. First of all, what is venture capital? And venture capital is very unique, whereas there is a lot of ways in which capital is provided to businesses. When you talk to investors, you will hear, equity and debt. You're all economic students, I guess. You understand all the various asset classes and instruments through which capital can be infused into a business. The unique thing about venture capital is it provides money or capital for innovation, because this capital is infused at a time when a company is very young, and you are not actually investing in a company. You don't have a balance sheet to that extent. You don't have a P&L statement that, all the formulas that you learn in economics about analyzing balance sheets and calculating ratios don't exist at the time that a venture capital makes an investment. Venture capital is invested on an idea, and it is invested on people who give the confidence to the venture capitalist that they can execute on that idea. Typically, the money that comes to a venture capital firm, for example, Dallas Venture Capital, where I am a partner at, gets money from high net worth individuals, institutions who will provide, they are called LPs. The LPs provide this money with a mandate to invest in young startup companies with great ideas and great people. The general partner or the venture capital firm then evaluates each one of the entrepreneurs' ideas who come, and it is called a pitch deck, who come and pitch their ideas in terms of what is the product, what is the technology, what is the idea that they are thinking, what is the market, it's called the total addressable market TAM, and then what is the market that that particular startup wants to address, and what is the product, what will be the product market fit, what will be the type of customers, what will be the team that is required, what will be the timelines. All of this gets covered in a pitch book based on which a venture capital firm will decide to make an investment. Typically, venture capital invests in either pre-seed or seed, where you just have an idea, or in series A or B, which essentially is you have some customers, you have a MVP or a minimum viable product, you have a little bit of revenue, you have some customers who are willing to try out your idea because they have a need over there, and you have a reasonable team put together who will work on the product of the company. So typically, angel investment or a pre-seed or a seed would be a very small amount. In dollar terms, it would be about sub $1 million, 100, 200, $500,000. In rupee terms, it would be a crore or so. And then you would come to, typically the seed or angel investments are either done by friends and family, some of the entrepreneurs themselves, or in some cases, there would be some funds who would make some seed investments. There are a number of incubators. One of the things which is happening, which is very encouraging in India, is there's a number of incubators coming up across the country to be able to incubate these startups and ideas. Then typically in Series A, a venture capital firm will come where the valuation of a startup could be anywhere between about $8-10 million to $25-30 million, and they would invest a small amount of anywhere between, say, $1 million to about $5-6 million. Some of these numbers are going up as valuations of companies are going up in this environment, especially technology startups catering to digital transformation and digital consumer kind of areas. So we talked about angel investment, seed, pre-seed, as well as then we talked about Series A. The next comes Series B, where venture capitalists are quite involved. It could be a larger ticket size of investment. Typically, a startup would be valued at about $30 million to $60 million, sometimes even up to $100 million. And the ticket size for that investment in those cases could be a double-digit $1 million check that a venture capital firm would write. Some venture capitalists would move from Series B to even Series C, but then after Series C onwards, the check sizes become much bigger, the companies become much bigger, and then you enter the traditional route of investing through private equity, institutional investors, hedge funds, and others. And the venture capital side of it starts waning down. Although some venture capital funds may continue to invest or co-invest because they want to partake in the upside that gets created. But primarily the objective of a venture capital fund is to get a company started, do a high risk investment, and that is why a venture capital expects a higher reward. Typically, my experience has been that if a venture capital invests in 10 startups, there is a very good chance that about 6 or 7 of those 10 startups may disappear in a year, 2 years, or 5 years. So it is okay to fail. Venture capitalists, unlike a lot of other investors, are okay for somebody to have a great idea, and that idea may not work out for various reasons. And that's okay in the venture capital industry. There is a good chance that 2 or 3 of those firms may return your capital and give you a reasonable return, which would be a traditional rate of return, beating inflation, beating what you would get in equity markets or interest rates. And there could be 1 or 2 companies that could just go off the chart, become a Flipkart or a Google or all the famous startups that you hear about. and you can get 10x, 20x returns on it. Overall, a venture capital would be a successful venture capital when they are able to, on a portfolio basis, get return from about 3x to 5x on the invested capital. And that is why I say that it's a high risk activity, and that is why the expectation of the return is also relatively high compared to a traditional equity market return or a fixed income return that you would expect. So why do we need venture capitalists? The key reason for venture capitalists is embedded in what a venture capitalist is. The traditional forms of equity investments don't allow for this kind of a high risk investment. So we need venture capital industry to be able to encourage innovation, because most of these companies are very innovative. They are not companies who are doing the traditional things. Having worked in the enterprise world and serving enterprise customers for 3 decades, I have realized that it's very difficult a lot of times for very successful organizations to have disruptive innovation within themselves, because their success becomes the biggest constraint for them to innovate a very disruptive idea that can disrupt their own business and disrupt their own industry. And that is why you need startups. You need newer disruptive innovative companies, and venture capital is required to be able to get them off the ground. Venture capital is also required because there is a level of domain expertise. Unlike a traditional investor, or when you look at a profile of a private equity person or a traditional investment banker or people who participate in investment decisions, they are very savvy financial folks. But because in venture capital, you're investing in an idea and you're investing in people, the kind of talent that is required to evaluate those kind of investments is beyond what the traditional financial services industry brings, which is all about ratios and all about financial metrics. And that is why a different class of people are required to be able to make venture capital investments. And that is why venture capital is needed, because although they are people primarily in the business of funding, but it requires a different kind of talent that can evaluate and make decisions for that funding to happen. So I talked about what is venture capital and why we need venture capitalists. Now I will come to the question that was asked about the differences between the Silicon Valley kind of ecosystem and India. But before that, let me tell you why I am so excited about the venture capital industry in India. There are 4 things essentially that are required for a venture capital and a startup ecosystem to become successful in any market in any country. The first thing is talent. You need to have people who have innovative ideas and are willing to take risks. India has proven itself to have the best talent in the world, especially in the area of technology. So that nobody questions anymore. With the CEO of Google and Microsoft and many other successful technology companies being ethnically Indian, makes that sell very easy. So I think as a country, as a community of people, we have proved that we have the talent in India to do that. But historically, what was happening was that talent had to come to the US and other places to become successful. Now, the big change that is happening is India is evolving itself and creating an ecosystem. So after talent, what is required is an ecosystem to promote startups, to promote the venture capital industry. And the ecosystem has many parts, but some of the parts are, what I call as the invisible atmosphere. Like you are there in an ecosystem where oxygen is around you, the atmosphere is around you, and you can breathe and you can live. Initiatives like NASSCOM, initiatives like the Startup India and Digital India, which is promoted by the government, encouraged by the government and institutions, things like the Atal Innovation Mission. One of the biggest difference used to be in the US, there was the Stanford University. A lot of the Silicon Valley gets its name. When you think of Silicon Valley, immediately one of the things that comes to your mind is the Stanford University. It was the hub. Palo Alto was the hub of innovation. Today, the IITs and many, many other institutions are creating that same ecosystem for young students, young people with great ideas to be able to incubate their ideas. So that's another part of what I would call as the ecosystem. So government on one hand, institutions like SIDBI or NASSCOM or Atal Innovation Mission on the other hand, IITs and institutions which have incubators. For example, my alma mater, both IIT Bombay and NIT Raipur today have incubators where young folks can actually try their ideas, get some seed funding from alumni, from the institution itself, supported by the government, to be able to start and try out ideas. You know, amounts as small as 50,000 rupees, 100,000 rupees, couple of lakhs. For a student, even that kind of money is pretty much out of reach to get something started. And these incubators help them, these accelerators help them start that as well. So the second one is the ecosystem. The third is capital. You know, the India in which I grew up when I was a child, we were seeing a migration from what I call as fixed deposit savings to investing in equities. So my parents and a lot of people of my generation's parents would always put all of their money in fixed deposit because it was the most secure investment to depend on that money for your retirement. People were not bold enough to invest in equities. That change happened during my generation. And you know how BSc and NSc have been doing, because Indians are now much more comfortable investing in equities. Today's generation, people who are my peers, who've grown up in the Indian IT industry, who've grown up in a very global framework of businesses, are now comfortable investing and moving from asset classes which are beyond equities. And one of that asset class is venture capital. So there is capital available now in India, which was not available before. And that was a key difference between the US, Silicon Valley, and India. Availability of risk capital, availability of venture capital, which is now becoming available in India. And there are some very successful venture capital firms, including the Dallas Venture Capital, which I am a part of, which has a fund now in India. So we talked about talent, we talked about ecosystem, we talked about availability of capital. And the fourth thing which is required for a successful startup ecosystem is customers and enterprises. This is required because both, it is easy, you know, if you look at some of the early venture activity in India that happened around the consumer segment, whether it is Ola or Flipkart or many, many other successful startups, were all in the consumer segment, because the Indian consumer became digital far ahead of the Indian enterprises becoming digital. So they were accepting some of these new disruptive ideas much faster. We all know how pan walas and kiryana walas are able to do transactions on the cell phone. For a B2B environment to be successful, we need enterprises to be able to accept. A lot of times Indian enterprises, and that is true still today. If you ask me, one thing that we still have to overcome between the US and India is Indian enterprises accepting disruptive technologies and startups in their own technology stack. A lot of times, a large business house in India may feel much more comfortable buying technology from a US company rather than buying it from an Indian startup. And what I tell them is, if a startup has to go to the US to sell their product or technology, they will never have a startup in India, because then venture capitalists like me will ask them to move to the US, because you always want your company close to where your customers are. So today, if you ask me, the biggest difference, which is again, the gap is going away very quickly between India and the US in terms of the startup ecosystem, is the acceptance of Indian business houses for not only buying from Indian startups, but also providing opportunities for exit of Indian startups. And today, if you open the newspaper, everywhere there is a news where whether it is Reliance or whether it is the Tata Group or many other companies who are continuously acquiring and buying startups in the digital area, providing them opportunities for exit. Because only when an exit happens, only when a startup gets sold does cash and liquidity, real wealth, get generated. Otherwise, all the valuation that happens of a startup is all paper valuation for the founding team and the entrepreneurs. So I talked about 4 things. I think very quickly, India is coming to the same level as US or Israel or any other country that is known for its startup ecosystem, that's known for its venture ecosystem, because we are bridging that gap very quickly. But just because the question was asked, the one thing that I think we can do much more is Indian consumers and, more importantly, Indian businesses buying from Indian startups and encouraging Indian startups more as their providers, so that the startup ecosystem can develop much better in India. I'm very encouraged with the numbers. About in early 2000, venture capital industry did not exist in India. By 2010, 2012, about $2-3 billion was being invested in India by venture capitalists. In the last 2 or 3 years, in spite of COVID, double-digit billion dollars, 10, 11, 12 billion dollars every year is being funneled into startups through the venture capital industry. So the growth has been an order of magnitude every decade, and that's very encouraging. Also, the number of deals are increasing. From about 200, 300 deals in the 2010s, now we are seeing about 800 to 1,000 deals in today's environment every year, where a venture capital fund is investing into a startup. And the average deal size is also going up, which means more serious capital is going into each one of these areas. Although we are still far behind, because a country of 1.3 billion people and the world's 6th largest economy by GDP, we are comparable to the United Kingdom. And United Kingdom has approximately about 2,000 to 2,500 deals a year, whereas we still have 800 to 1,000 deals. Of course, US has much higher number, over 2,500 deals. Even a small country like Israel has about 500 deals a year. So while we are on the right track in India, I'm very enthusiastic about it, but there is much more to do. And I'm expecting the 200 people on this call to become entrepreneurs and participate in the venture capital activity, to really not only produce the number of jobs that we require as a country, but to lead the world in the technology revolution that is happening, and a chance to kind of get ahead of most of the other developed countries in terms of leading with technology. I'll spend a few minutes on my thoughts of what is the future of the venture capital industry, and then we'll open up for questions. One of the things that I have seen, and that is why I decided to participate in the venture capital industry, is capital is very important, but capital is necessary but not sufficient for a successful venture capital industry. What entrepreneurs today are looking, good entrepreneurs actually can get capital from many, many sources. They can have venture capitalists lining up behind them to say, take my capital, take my capital, take my capital. What they are also looking for is mentorship. People who have got experience, entrepreneurs who've built companies, people like me who have built businesses over the years, dealt with global customers, to mentor these teams in terms of leadership, in terms of being able to run businesses, in terms of compliance, taxation, many, many areas where entrepreneurs struggle because they have a great idea. They can start a business, but there's many other things around a business that you need to manage. So mentorship becomes very important. The second area is access to clients. The most difficult thing, especially if you're in a B2B startup, is the ability to access customers, large Fortune 500 organizations who have very complex buying processes. Somebody like me has spent a career selling to Fortune 500 companies. I remember when I was a young salesperson at TCS, how difficult it was to sell to a Fortune 500 company in the US who did not even know what TCS stood for. Today, it's a different thing because it's such a famous company. And that needs a lot of perseverance, that needs different tricks of the trade to be able to do that. And we help entrepreneurs do that. The third thing that is required is help with messaging, because it's not only about having the best product and having the best product market fit. Sometimes we have to help entrepreneurs to create a market fit for their product. I'll give you an example. We invested recently in a startup which had a great team of technologists who understood the LiDAR technology, which goes in cars and cameras and many, many things, which enables not only 2D photography, which we all know, but adds the third dimension in terms of the depth in photography. But the issue was they had so many ideas. We helped them narrow down their idea to one industry, which is the insurance industry, and said, look, if you are able to create an app where in the COVID environment, an insurance adjuster is able to, rather than coming to a person's house where everybody will feel very uncomfortable having a third party come inside your house in a COVID situation, a customer can take a video on the cell phone and upload it to the insurance company. Now, video is 2-dimension, and sometimes, for an adjuster to make a decision on a claim may not be sufficient. But LiDAR enables you a 3D video imaging. And that startup worked on that idea and it became successful. One of the large insurance companies has offered them $25 million of valuation right off the bat. So that is an example of a product market fit where venture capitalists can help the entrepreneur very significantly. And the fourth, obviously, is the exits, enabling the company to exit so that everybody really makes money, everybody is able to be successful, because as I said, until you exit, a lot of this is all paper money. So at Dallas Venture Capital, we call this as the DVC advantage, which essentially is helping startups or ventures beyond just providing them capital. And I think that is the future of the venture capital industry. The second place where I'm seeing an evolution of the venture capital industry is cross-border venture capital. Earlier, the venture capital industry was very local. So the Silicon Valley companies were investing in Silicon Valley and other places in local markets, micro markets. The investments were happening in the US, Austin, Boston, and Phoenix, and a few other places outside the Silicon Valley are good markets for venture capital investments. Now we are seeing cross-border because talent is cross-border, ideas are cross-border, and the venture capital industry is becoming cross-border. Even at Dallas Venture Capital, we are raising two funds. One is a Texas-based fund in Texas, and another fund is in India for Indian entrepreneurs. So we ourselves, as a team, are looking for investments which pan across two major markets or two countries that we are investing. So that's the next wave of venture capital. There are many other venture capital firms who are doing the same. With this, I'll just pause here. I think there is a huge opportunity. I invite many of you who think passionately about venture capital world to participate in that. You have opportunities to do internships with venture capital firms, become an associate, become a principal, and hopefully eventually become a partner. I'm sure there are a number of you who are thinking of startups and leveraging the venture capital industry to get your startup funded, so you could have opportunities over there. Or, if you have enough money, you could be an investor to the venture capital world. So many, many opportunities for young people like you. We want young people to be bold, to be risk-taking, and come in the venture world. I will pause here and I'd love to take questions.
Yes.
Thank you so much, sir, for your views. The first question is, you have worked in two tech giants that began as startups at the onset of your career and have recently ventured into mentoring startups and founders in the area of software products, especially B2B products. When you mentor or even invest in a startup, what are the telling signs you look for that draw you towards them and indicate that they have the potential to become unicorns or even giants?
So the first and most important thing we look at is the idea. Is the idea unique? Does it leverage technology in a very unique manner that is difficult to easily replicate? Right? So first is the idea. Second is we look at the market. Is there a market for that idea? A lot of startups fail because they are early in their time. Sometimes, entrepreneurs will tell me, Abid, if I would have started my startup 5 years later, I would have been much more successful. So the timeliness of the idea is also very important. Is there a market which is ready for a startup? Because remember, startup is a small company. They don't have millions of dollars of marketing money to create a market for an idea. So first, we would look for the idea itself. Second is the size of the market that is available and whether the market is ready. The third, which we place a lot of importance, is the team. Because we know a lot of great ideas, even which are timely or we think are timely, may not be successful. And that is why having a team which we believe in, which is very passionate about it, and they put their own skin in the game. Just as an example, if a CEO of a founder of a startup wants to have a large salary, a crore rupee salary to start with, is a red flag for us. Because if a founder himself or herself is not willing to put their own skin in the game, why would you expect a venture capitalist to put skin in the game? So we look at the team very carefully. We look at the value system of the team very carefully, their learnability, their potential, their passion very carefully, because a lot of venture capital investment is about investing in people rather than investing in business. So those are some of the things that we look carefully in startups. Then there are a few other things which would be more about the details of the business plan and stuff like that. But some of those things get done in the due diligence phase itself. By the time it comes to me, I just look at these three things and then sign a check.
Okay, sir. So the next question is that one of your earliest mentors was Nadarajan Chandrasekharan. So what would you say is the single most important thing that you learned from him, or any other mentor that played a major role in shaping what you are today?
I have been very blessed and fortunate to have a number of great personalities as my mentors. Of course, Chandra being one of them. And the biggest thing I learned from Chandra is to think big. Every time, raise the bar on what is the art of the possible. And I've been very fortunate to be working closely with him and learning a lot from him.
All right, thank you so much, sir. The next question that we have for you is that the Indian government has taken certain steps to boost the startup ecosystem of the country. What more can be done in terms of regulatory hurdles to attract better funding opportunities?
So this is a very technical subject. The good news is that the government is very receptive to ideas and feedback and suggestions. The Prime Minister himself personally talks not only to venture capitalists like us, but also to entrepreneurs and people who are doing startups to understand what are the hurdles they face and how they can be eliminated. A very good example is recently around the angel tax, because inadvertently the angel tax was becoming an issue for venture capitalists to be able to invest in startups in India. And the government moved quite rapidly to address that issue. So, I think the way I look at it is that there will always be venture capital and startups is a very different kind of business. It's small. It doesn't have the wherewithal to handle a lot of regulatory requirements, to fill up Hajar forms, to have a general counsel and a chief financial officer and an accounting team who's doing all of this full time, either for the taxation guys or for the labor commissioner or for the any other regulator, whether it is health and safety or whatever it is. So the government continuously looks for ideas, and as long as we are able to give feedback and those things get addressed, it is almost like, when you have an infant in the house, you don't expect the infant to participate equally in all the chores that are there in the house, right? You don't say the infant has to wash dishes and the infant has to clean the house and the infant has to participate in pressing the clothes. But as the child grows, the child has to take responsibility, because all the life a child of the house cannot be dependent on the rest of the family members. That's how I look at a startup and the startup ecosystem. So the startups have to be protected in the first 4 or 5 years, and then slowly the regulatory burdens have to come on it, taxation burdens have to come on it, so that it is strong enough, big enough to be able to then pay back to the country what it got in terms of protection and enablement and support in the first 5 years.
Thank you, sir. So the next question is from one of our audience. So, sir, if you were to start a startup right now, would you first go to a venture capitalist to increase your production, or would you let your startup to take its own time to set up so that later on you can make decision about the company, which would not be possible if you take a venture capital right now? Because
A great question. A great question. I always tell entrepreneurs, or if I were to do it myself, that if you have seed funding available, either your own money or friends and family or angel investors, don't go in a hurry to an institution to get money. Whether it is a venture capital, whether it is a private equity, whether it is a bank, whatever it is. Because early on, the fun about startups and business and entrepreneurship is it is your idea, you are passionate about it, you want to put a stamp of your own name on what you are building, it is your idea and you want to be passionate about it. And sometimes an investor can be overbearing. Although at DVC we try to say, look, we are not going to interfere with you, do whatever you want to do, but still we always keep watching our money over the shoulder because we don't want our money because it is somebody else's money that we are also fiduciaries for, right? So as a young startup, as a starting point, I always advise entrepreneurs, put your own money, take money from friends and family if you can, take money from angels who will give the money and forget about it, and create something which then at an appropriate time at the right valuation, you could take to institutions, even if the institution is a venture capital, to then take a larger investment. Because then your ability to negotiate, your ability to prevail in terms of your point of view is much better than at a very early stage.
Thank you so much, sir. The next question is, which type of startup will you be more willing to invest in? A technical startup that is related to IT or a startup which is promoting employment in backward areas?
So at Dallas Venture Capital, we are focused, we have a charter and we are very focused on B2B SaaS software companies, companies who create a software platform or a product whose customer is a large enterprise of global 2000 or a Fortune 500 enterprise. Every venture capital has their charter, and based on the charter, you take money from your LPs, your investors. So you have to be within the parameters of the charter. I'm very personally passionate about social capital and social investment, because for the future of our planet, for the future of humanity, we need social enterprises and we need to invest in them. So there are a number of venture capital organizations who invest in social enterprises. Personally, for my business, I would invest in B2B startups. On a personal level, I would invest in a social enterprise which looks at areas like net zero carbon emissions or education technology and bringing education to some of the most underprivileged communities, and healthcare, again, to people who don't have access to healthcare, and many other social causes which could be very close to one's heart.
okay, sir. So our next question is asked by our audience, Kriti Panwar. So the question is, as explained by you, the venture capital industry has established itself in the metro cities of India also, but what can be done to bridge the gap that exists between the venture capitals and the rural entrepreneurs who have the idea and potential to solve some of the grassroots level problems through their innovation in the Indian villages, including in sectors like agriculture, food production, tourism, etc.
So a good thing that COVID has done, COVID has been very tough on many of us and a lot of the families and communities around us. But the good thing that COVID has done has made the world virtual. About 2 years back, I couldn't have imagined writing a $3 million, $5 million check to a startup without having dinner and personally meeting the team of the startup. In the last 6 months, I would have made about 4 or 5 investments with only meeting the team in a virtual manner like Zoom, like what we are doing right now. So for an entrepreneur in a village or any part of the country or any part of the world for that matter, today it is much more easier because it doesn't matter. When you are sitting here and asking me questions, Abhiram, I don't know whether you're sitting in your village. From the trees and your background, I think it may be a very beautiful village that you're talking from. Or you're sitting in the NCR in heart of Delhi asking me the question. So today it has become quite irrelevant as to where you are coming from. But there is aspects of ecosystem. For example, if you want to start a startup in a village, will you get talent? You know, I talked about the 4 things that are required for a startup. Will you get talent? Will you get capital? Because you have to be comfortable. If you tell me that, look, I'm going to have this startup in eastern Uttar Pradesh to address some local issue, then most likely the venture capitalist also has to be local, who understands that market, who understands that area or that space. So you have to go to the right venture capitalist. Similarly, is there an ecosystem around that? Because the startup needs a lot of support. Will you find an incubator that will help you incubate that? And as I said, the government is doing, one of the things that I find very, very encouraging is now the incubation is coming down from the IITs, which are primarily the metros, to the NITs. And a lot of other colleges are setting up incubators. These colleges in India are pretty spread across, although they may be in a state capital, but still they are in every state. And that at least takes the next step to move from tier 1 cities to tier 2 cities. And hopefully over time, it will move to tier 3 cities and rural areas as well. But I think the direction is right.
Thank you so much, sir. The next question that we have for you is that we have seen apprehensions in India with regards to adoption of cryptocurrency. Seeing the latest rise in the values of many cryptocurrencies like Ethereum and Bitcoin, and how there is a lag in the Indian mindset when it comes to cryptocurrency, now furthered by this ban, how do you think this will affect the future of Indian startups and innovations?
So cryptocurrency is just one part of many, many other avenues and opportunities for startups. And personally, I think cryptocurrency is here to stay. It will be more regulated than it is today. Because one of the key fundamental objectives of cryptocurrencies is it being a digital currency, not requiring paper. You being able to transact from your iPhone or from your phone, smartphone, or from your computer. There are many alternatives to that, but that's a very viable mode of digital currency. UPI is a great achievement for India. Without cryptocurrency, people can do digital currency transactions in India. The second thing that cryptocurrency does, which government, so this is the first thing governments love, because government want to encourage paperless transactions. The second thing that cryptocurrency does is it disintermediates the central banks, like Reserve Bank of India or the Federal Reserve in the US or any other country. And governments, because they are sovereigns, they rule sovereign states, like to have control over the currency for various reasons, good and bad. The good reasons is when there is an economic hardship, the government asks the central bank to print a lot of notes and flood the market with money. It's called monetary easing. You're all students of economics and you understand how governments do fiscal management, how governments do monetary management to be able to boost the economy, or if it's a very heated up economy, they increase interest rates and then try to cool down the economy, whatever they need to do. Some of the levers that are available to the government are through the central bank and the currency. And crypto takes away that control or levers from the government, which in my mind One can argue one way or the other, but I think you cannot have a lawless state. And this is part of the lawlessness that cryptocurrency can threaten to bring in the monetary and fiscal aspects. So that is where I think in the long run, digital currencies and cryptocurrencies as a technology will stay, but they will be more promoted by the individual sovereign governments than by private organizations, that is happening right now. But the jury is still out, and we'll watch the space quite closely.
Okay, sir. Thank you. So the next question is that you've talked about a 5-year gestation period as far as new enterprises are concerned. But these days, startups are more about growth at all cost, and they don't start making money, paying taxes, etc., like a typical company for a few years. Do you think that we are going in the right direction?
So again, it depends on the product, it depends on the space. If it is a consumer startup, it is important that you acquire consumers, you acquire customers early on. And sometimes the strategy to acquire those customers is a free model, right? So you may not make revenues, you may not make profits. If you're serving enterprises, you may have to do free pilots and proof of concepts to be able to establish yourself inside an enterprise. So I would not rush into counting revenue for a startup. I would give it time, but I would keep it on a tight leash on cost management when they are not making revenue. Invest in the right places like product engineering and other, and make sure that we are not too extravagant on areas which don't need so much money. But eventually there has to be a clear path to not only revenues, but path to profitability and path to cash. Because I personally always believe that in the long run or in the medium term, the whole business enterprise has to create cash and meet the objectives of all stakeholders, including paying taxes to the government. But what you can argue is, like we said, for a child, an infant, how old do you want it to get before you raise the expectations from the child in the family? So that same thing applies to a startup. I wouldn't hurry into it.
Okay, so sir, I'll ask the next question. While people often talk about the skills and the kind of mindset entrepreneurs need, on the opposite side, what is it for an aspiring venture capitalist?
Can you repeat the question? I didn't understand it.
Okay, sorry, sir. So people often talk about the skills and kind of mindset entrepreneurs need to have. On the opposite side, what is the kind of skills and mindset an aspiring venture capitalist should have?
A venture capitalist should have a very strong heart, because you're giving money to somebody and you're not sure what's going to happen to that money. So, one very interesting thing I realized in the venture capital world is when I was in the enterprise world, if I was working for TCS or if I was working for Wipro, we would hide a deal that we had from all our competitors. I would never let competitors like Infosys or Cognizant or Accenture know about a deal I was working on. The venture world is a very collaborative world. Venture capitalists feel much more comfortable that two other venture capital firms are co-investing with me. If the company needs $10 million, 3 venture capital firms will come together and say, okay, let's distribute it 4-3-3 amongst the 3 of us. So we can spread the risk. So the venture capital world is a high risk world. It needs to have the ability to take risks. It needs to have very strong fiduciary mindset. because you're dealing with somebody else's money. You are taking money from LPs and channeling it to startups. You should have strong domain expertise in the area. I do believe that domain expertise is very important to understand the area that you are investing in so that you can do justice. And the expectation of rewards, rightly so, are very high. So don't feel jealous about a venture capitalist when the venture capitalist makes tons of money, because people see the time when they make the money, they forget the time when they took the risk and made an investment. And as I said, about 50% of startups fail. That's the nature of the business. So the only startups that you hear in the newspaper are the ones that became successful. Like it is exactly like playing cricket, right? I grew up in Bombay, and in every street in Bombay on every Sunday, everybody plays cricket, right? But we only come to know and remember Sunil Gavaskar and Sachin Tendulkar and everybody who played on the streets, who made it to the India 11, not the millions of kids who played and wanted to make it to the India 11, but ended up doing something else in their lives. So the startup world is also very similar to that.
Thank you so much, sir. You talked about Israel's startup ecosystem, which is pretty dense given the current country size, and a lot of disruptive startups have come out of Israel. While Israel's culture of innovation, perseverance is ideal for a startup ecosystem to flourish in, what qualities do you see in India's social behavior that can foster the growth of the startup ecosystem?
I think, as I said, I see everything right in India. Of course, India is a very large country and the inequality is very, very high. So there are people in India who would struggle just to make ends meet and have 2 square meals a day. And there are people in India who would have ton of dispensable cash who can invest in venture capital endeavors. So Israel is a relatively small country. A set of people who, but on an average, are much more educated, having access to education, having access to capital, being successful. So it's difficult to compare India as a whole with a country as small as Israel. But there's a lot to learn from there in terms of talent, which we have, and promoting talent. The biggest thing India can do is make sure that our talent doesn't leave our shores and migrates to other country to become successful. So providing opportunities to young people within the country, providing capital to young people. Sometimes as the digital technologies develop, I transact with India in many, many forums. And a lot of times, while digital India has become a reality, but a lot of times a government officer will tell you, okay, you've done this transaction online, but please take a printout and take a attestation and sign and give this form. I'll keep it in my file. Because the Sarkari officer has difficulty in understanding that what if my computer breaks down or I don't have access? How will I prove that I did the right thing? So they keep a file in their own back office with all the printouts. And then they don't trust in the printout, so they want somebody to attest the printout and stuff like that. So there are a lot of things in the mind that needs to change. While the laws can change, the government can drive the change at a visionary level, but on the ground, people feeling comfortable to do things which are truly digital, which are truly paperless, is also a very important change, which in a country as large as India takes much longer than a small country like Israel would take.
Okay, sir. So you would have had a very long career, about 33 decades long career in various industries. So is there any one particular experience which you think stands out to you?
Oh, there are many, many experiences that I can talk about. But one of the things I love talking about, and it is true for a corporate career, but it is equally true for the subject that we are discussing today, which is startups and venture capital, is the need for each one of us to take risks. In some sense, I'll connect it to the previous question on Israel as well. I have a number of friends who are Israelis over here. And I have a very analytical mind, so I always try to pick up some soft signals of what differentiates us and Israelis. One of the things I learned is that Israel is such a tiny country, surrounded by primarily most of the other countries who think they are enemies of Israel. So they're okay to live with a level of insecurity. And they can carry normal life in spite of that insecurity. Same thing I would say, for young people, or at least I practiced in my life, is don't try to always chart a secure path. So earlier I gave an example of capital, and you guys are all economics students, so you'll understand capital. Putting your money in fixed income, in a fixed deposit, which will give you 7% interest with zero risk, is the most secure path that you can take. After that, every other path you take, and even that fixed deposit is in a government treasury in a State Bank of India, is the most secure. Even a private bank, there is additional risk, and then the risk keeps going up. So the ability to take risk is, I think, very important. And personally, I have many stories around that, but one of the things that I have always done in my 30-year career is thought of doing something next in my career. Every 3 to 5 years, you do a new role, a new jig, a new, I've been fortunate only to work in 2 companies, but I've never done the same thing for more than 3 to 5 years in any one of those companies as well, right? When you're doing the next thing, the question I asked myself is, am I doing what everybody else is doing or aspiring to do? Or am I doing something that others are afraid of doing or are uncomfortable doing? And if the answer is the former, then I wouldn't do it. If the answer is the latter, then I would feel very encouraged to do it. Which is nothing but being able to take a calculated risk, being able to chart a course of your own, which is not what many people are doing. And in my career, there are many, many such examples that I have done. I'll tell you one of the first examples, and I'll tell you one of the last examples. One of the first examples was as a young guy having given a campus interview at IIT Bombay and entered TCS. There were 2 things that happened. Number one, everybody in those days, all my friends, wanted to go and work for Schlumberger or Citibank or many, many of the American companies which came to hire young Indians out of IIT Bombay campus. I got selected by TCS, but that was because I went for a practice interview, because I'd never given an interview. The next day was an interview of an American company that I wanted to actually get selected. I realized that after the practice interview and the real interview, I got selected in both the interviews. And all my friends would go to the American company because that's what every IITian used to do in those days. I selected to work for Tata and TCS, at that time an unknown company. Pretty much, even if you knew Tata Group, you would know Tata Steel and Tata Motors, not TCS. Similarly, last year, when I decided to quit a CEO's job and become a venture capitalist, a lot of people said, nobody gives up a $30 billion market cap company public CEO role to come to do a $50 million, $100 million venture capital fund, right? So I think charting out new course for the future for yourself is important, but it takes a level of courage, it takes a level of risk, and that is what I would, at least I have done, and I have thoroughly enjoyed doing it. Not everything goes as planned, and you're not successful in everything. So the second advice I would give is, don't get disappointed.